In the last 12 months, PDD brought in $64.14 billion in revenue. Out of that, it kept nearly $14 billion as operating income and earned $13.87 billion in net profit. Now, net profit is basically what's left over after paying all the bills: employees, taxes, operating costs, everything. A profit margin of 21.62% means for every dollar PDD earns, it keeps over 21 cents as pure profit. That's a very healthy number, especially in the competitive world of e-commerce. Now, here's something that really stands out: the cash. PDD Holdings is sitting on $63.22 billion in cash, and they carry almost no debt, only $742 million in total debt. That gives them a net cash position of over $62 billion. To put that in perspective, the cash they have on hand is actually more than their entire enterprise value, which sits at around $53 billion. Enterprise value is basically what it would cost to buy the whole company, debts and all. So in a very real sense, if you bought PDD today, you'd be getting the business for free and still pocketing billions in leftover cash. That's a rare situation. Speaking of valuation, this is where it gets interesting for investors. The stock trades at a price-to-earnings ratio of just 8.72. PE ratio, or price to earnings, tells you how much investors are paying for each dollar of profit. A lower number typically suggests the stock might be undervalued relative to how much money the company is making. For context, the broader market often trades at PE ratios of 20 or higher. PDD's forward PE, meaning what analysts expect next year, is even lower at 7.34. The PEG ratio, which factors in expected growth, sits at just 0.89. Anything below 1 is generally considered a sign that a stock might be priced attractively given its growth potential. Now let's talk about financial health. The current ratio is 2.54, which means the company has $2.50 in assets for every $1 of short-term obligation. That signals a very comfortable financial cushion. They're also generating $15.77 billion in free cash flow. That's the cash left over after all spending and investments. Free cash flow is the lifeblood of any business because it tells you how much real money the company is actually producing, not just on paper. But it hasn't been all smooth sailing. The stock price has dropped nearly 21% over the last 52 weeks and has a relative strength index, or RSI, of just 32.44. RSI is a momentum indicator. Readings below 30 typically suggest a stock is being oversold, meaning investor sentiment may have pushed the price down more than the fundamentals justify. The stock is also trading well below its 200-day moving average of $111, while currently sitting closer to the $80 range. So what do analysts think? The average price target from 36 analysts covering this stock is $119.99. That's about 47% higher than where the stock is trading today. The consensus rating is a buy, with 3-year revenue and earnings growth both forecast around 10.5% annually. Zooming out, the Altman Z-score, a formula used to measure financial distress risk, comes in at 5.65. Anything above 3 is considered a strong safety zone, meaning the risk of financial trouble here is very low. So here's the bottom line. PDD Holdings is a company with massive profits, extraordinary cash reserves, minimal debt, and strong free cash flow, trading at what appears to be a significant discount by almost every valuation metric. But the stock has been under pressure for over a year, and there are broader macroeconomic and geopolitical factors around Chinese stocks that data alone can't fully capture. As always, do your own research, understand your own risk tolerance, and make decisions that make sense for your own financial situation. Thanks for watching, and don't forget to like and subscribe for more breakdowns just like this one.